So, while it seems like every other investor is scrambling to figure out what Trump's new economy means for their money, I've spent the last several months repositioning my entire dividend portfolio to be 100% ready. I'm not just trying to survive the next 4 years, I'm aiming to generate serious income from the key economic policies being put into place. We're looking at a potential roller coaster of policy shifts, new tariffs, and deregulation, which is stirring up a whole lot of uncertainty. And frankly, most portfolios are built for a world that just isn't here anymore. They're dangerously exposed. In this video, we're not dealing with vague theories or fuzzy predictions. I'm going to pull back the curtain and show you the exact sectors and dividend stocks I'm holding for the next 4 years. This is my personal playbook, the result of countless hours of research into this new economic landscape. I've built a portfolio designed to be an income-generating fortress no matter which way the political winds blow. We'll break down why I think these specific areas are ready for growth, how they line up with the administration's stated goals, and the exact dividend stocks I'm using to capitalize on it. Now, before we get into it, the standard but very important disclaimer. This is not financial advice. I'm sharing my personal strategy and research for educational purposes. You have to do your own homework and talk to a qualified professional before making any investment decisions. My goal is to show you the framework I used to prepare for what might be coming, so you can think critically about your own strategy. If you appreciate that kind of transparency, do me a quick favor and hit that like button and subscribe for more content just like this. It really helps the channel and tells the algorithm that serious investors are looking for this kind of detailed, no-nonsense content. All right, let's get into the strategy. All right, let's start with the first and biggest pillar of my new portfolio, American energy. This probably isn't a surprise to anyone paying attention. The administration's stance on energy is one of its clearest policy positions: achieve and maintain American energy dominance. We've all heard drill, baby, drill, but it's more than a catchphrase. It's a direct signal for investors. The agenda is aimed at aggressive deregulation of the energy sector. We saw a rollback of environmental regulations during the first term, and the current agenda points toward continuing that trend. Now, while the exact pace and scope of new deregulation aren't fully set in stone, the direction is clear. Less red tape means lower operating costs and quicker project approvals for oil and gas companies. That translates directly to better profits and, for us, more cash for dividends. The whole idea is to unleash domestic producers to maximize output, which puts American energy companies in a great spot. On top of that, the global political scene makes energy independence a huge national security issue, a theme the administration brings up constantly. By prioritizing domestic production, the U.S. can insulate itself from global supply shocks and political drama overseas. This creates a protected environment for U.S. energy producers. While other sectors might get hit by trade disputes, domestic energy is being treated as a strategic national asset. That's a powerful tailwind that I think a lot of investors are underestimating. They see the day-to-day volatility in oil prices, but miss the policy-driven foundation being built under the industry. So how am I playing this? I'm not just throwing money at an energy ETF. I want companies with bulletproof balance sheets, a history of raising dividends, and direct exposure to the benefits of deregulation. My main holding here is Chevron, New York Stock Exchange, CVX. It's a fully integrated oil supermajor and a perfect example of a company built for this environment. First off, it's incredibly resilient. Chevron has one of the lowest break-even points in the business, with its upstream operations needing oil to be around just $30 a barrel to be profitable based on recent figures. That's a huge metric. It means even if oil prices tank, Chevron can still make money while its competitors are losing cash. This gives its dividend a massive margin of safety. And that dividend, it's a rock. Chevron has raised its dividend for 38 years straight. That streak covers the dot-com bust, the 2008 financial crisis, the 2014 oil crash, and the pandemic. This is not a company that gets easily spooked. The current yield is a very healthy 4.4%. This isn't some risky speculative yield. It's a durable income stream from a company that knows how to execute. What makes Chevron a great fit right now is its huge operational footprint in the US, especially in the Permian Basin, one of the cheapest places to get oil in the world. This domestic focus is a direct beneficiary of any deregulation. Plus, its recent acquisition of Hess adds even more high-quality assets to its portfolio. To complement Chevron, the second stock I hold in this space is Enbridge, Nyesenb. While Chevron pulls oil out of the ground, Enbridge is the toll road that moves it. It operates a massive network of pipelines that transport oil and natural gas across North America. Its business model is completely different. About 98% of Enbridge's earnings come from stable, long-term contracts. This means its cash flow is incredibly predictable and isn't tied to the wild swings in oil and gas prices. It's a classic utility-like business model wrapped in an energy company. As a dividend investor, you love to see this. Enbridge is a dividend machine that's hiked its payout for 30 years in a row, and it currently offers a beefy 5.8% dividend yield. As domestic production ramps up under a pro-energy policy, the demand for Enbridge's pipelines will only go up. More oil and gas moving through its pipes means more toll revenue. It's a direct beneficiary of drill, baby drill, but with way less commodity price risk. Holding both Chevron and Enbridge gives me the best of both worlds, the production upside and the stable infrastructure that supports it. Okay, moving on to the second pillar of my portfolio, defense and aerospace. The theme here is straight out of the administration's playbook, peace through strength. This philosophy means a serious commitment to military spending and modernizing the U.S. armed forces. This isn't a new idea, but the current focus suggests this trend is about to get a serious boost, creating predictable, long-term demand for the top defense contractors. During Trump's first term, the defense sector did very well, and with the current geopolitical climate, that's likely to continue or even accelerate. Projecting strength on the world stage requires a well-funded, high-tech military. This is great news for companies that provide the hardware and technology for the Department of Defense. Now, you might think that fewer foreign conflicts would mean less business for these companies, but that view is a little short-sighted. Modern defense is all about technology. Cybersecurity, AI, space systems, and advanced missile defense all require massive, ongoing investment. These modernization cycles are long, and the contracts can last for decades, giving these companies incredible revenue stability. This isn't about short-term conflict, it's about long-term strategic advantage. The cornerstone of my defense holdings is Lockheed Martin, New York Stock Exchange, LMT. It's the world's largest defense contractor, and its product list reads like a who's who of critical military assets. From the F-35 fighter jet to missile defense systems and Black Hawk helicopters, Lockheed is woven into the fabric of U.S. national security. When it comes to the dividend, Lockheed has a great track record, with over 2 decades of consecutive increases, 23 years to be exact. The yield is sitting around 2.81%, which is really solid for an industrial giant like this. This is a steady compounder that benefits from a huge backlog of government orders. We're talking about multi-billion-dollar contracts that last for years, which insulates the company from the normal ups and downs of the economy. What makes Lockheed so compelling now is its involvement in all the high-priority areas of defense. The F-35 program has decades of revenue ahead of it. In space, Lockheed is a key player in everything from GPS satellites to deep space exploration. Its missile division is at the forefront of developing hypersonic weapons, a top priority for the Pentagon. So the thinking here is pretty simple. As long as the US is committed to being the world's top military power, Lockheed Martin will be a prime beneficiary. Its revenue doesn't depend on consumer spending. It depends on the US defense budget, which has strong support from both political parties and is being amplified by the current administration's stance. The stock has a healthy 74% payout ratio, meaning the dividend is well covered with plenty of room to grow. It's the ultimate sleep well at night stock for this peace through strength strategy. The third pillar I'm heavily invested in is domestic industrials and manufacturing. The driver here is the administration's America First trade policy, which uses tariffs to try and bring manufacturing back to the US. This is probably the most controversial part of the economic plan, and it's where a lot of investors get nervous. They hear tariffs and think trade wars and inflation, and those are real risks. In fact, some studies project that these tariffs could lead to a 6% long-run reduction in GDP and about a 5% cut in wages. But as a dividend investor, my job is to look past the scary headlines and find the opportunities. The clear goal of this policy is to make foreign goods more expensive and American-made goods more competitive. While this might cause some turbulence, it also creates a clear set of winners, US-based companies that make and sell their products mainly in the domestic market. They are shielded from tariffs on their own products and get a leg up on foreign competitors who have to pay import taxes. The administration's policy here is pretty direct. An executive order was signed imposing a minimum 10% tariff on all imports with much higher rates, up to 50% on goods from 57 specific countries, including China. This policy is designed to shake up supply chains and encourage domestic investment. For investors, this means finding the industrial champions that are set to do well in a more protected home market. My number one pick here is Nucor, NYSE NUE. The largest steel producer in the US, Nucor is the perfect America First stock. The steel industry has always been sensitive to foreign competition, especially from countries that subsidize their own industries and dump cheap steel on the market. Tariffs on imported steel act like a shield for Nucor, letting it compete on a more level playing field. Nucor's business model is also a huge plus. It uses electric arc furnaces to recycle scrap steel, which is cheaper, more flexible, and cleaner than traditional methods. This allows Nucor to run smaller, more efficient mini mills all across the country, close to its customers. This decentralized, domestic-focused model makes it incredibly resilient to the kind of supply chain chaos that hits its global competitors. And the dividend, Nucor isn't just a dividend aristocrat, it's practically royalty. The company has raised its dividend for over 50 years straight. Think about that. Half a century through every recession and market crash, Nucor has consistently raised its dividend. That says everything about its management and durable business model. In this economy, Nucor benefits from two things. Tariffs improve its pricing power, and any policy that boosts domestic manufacturing, from cars to construction, drives demand for its steel. It's the foundational building block of an industrial comeback. Okay, so while I'm positioning to profit from these big policy shifts, I also need to play defense. That brings me to my fourth pillar, owning tariff-proof consumer staples. An aggressive trade policy can have side effects like inflation or a slowdown. When that happens, you want an income source that's insulated from those risks. So what makes a stock tariff-proof? Simple. It's a company that does almost all its business right here in the US. It gets its raw materials here, makes its products here, and sells to customers here. This structure makes it fundamentally shielded from direct import tariffs, trade wars, and global supply chain nightmares. On top of that, consumer staples are naturally recession resistant. People buy these products no matter what the economy is doing. This combination of being tariff-proof and non-cyclical creates a powerful and stable income stream for the portfolio. My anchor here is a stock that's often controversial, but from a pure dividend standpoint, it's a beast. Altria Group, New York Stock Exchange MO. Altria is the parent company of Philip Morris USA and dominates the US tobacco market. Because it spun off its international business years ago, Altria's business is almost 100% focused on the United States. This is the key. It sources its tobacco from US farmers and sells to US consumers, making it fundamentally shielded from direct import tariffs. Let's talk about that dividend because it's pretty incredible. Altria is a dividend king with 56 years of consecutive dividend hikes. That's an elite club. Right now, it's offering a huge forward dividend yield of around 7.1%. In a world of higher interest rates, a yield like that from a company with such a long history of growth is very attractive. Of course, a lot of investors worry about the decline in smoking. That's a valid concern, but Altria's management has been masterful at handling it. They've consistently used their pricing power to raise prices, which has more than made up for volume declines and allowed them to keep growing earnings and dividends. The stability of its earnings is just remarkable. Its profits have been like a metronome for the past 5 years. So, in this portfolio, Altria plays a crucial defensive role. It's a high-yield anchor that's largely disconnected from the main risks of the administration's policies. While other companies are worrying about tariffs, Altria's business just keeps going. And if those aggressive trade policies, the ones some economists warn could shave 6% off GDP, do trigger an economic downturn, Altria's defensive nature should make it a safe harbor for income investors. It provides a powerful, stable income stream that balances out the rest of the portfolio. So there you have it. That's the 4-pillar framework I've used to position my dividend portfolio for the next 4 years. This isn't about politics. It's about looking at stated policies and positioning my money to benefit from them. Let's do a quick recap. First, we're overweight on American energy, taking advantage of the push for deregulation with best-in-class companies like Chevron and essential infrastructure plays like Enbridge. Second, we're investing in the peace through strength idea by holding a top defense contractor, Lockheed Martin, which is set to benefit from long-term military spending. Third, we're leaning into the America First industrial policy by investing in a domestic champion like Nucor, a steel producer poised to thrive in a protected market. And finally, we've built a defensive foundation with a tariff-proof income anchor, Altria Group, whose domestic business and high yield offer stability no matter what happens with trade. My entire portfolio is now built around these four themes. I'm confident it's not just ready to handle the volatility, but is set up to generate real income from these core policies. Where a lot of people see risk, I see a clear playbook. The next few years will likely be a stock picker's market, where just owning an index fund won't cut it. It will reward those who do their homework. But now I want to hear from you. What do you think of this strategy? What's on your radar? Drop your thoughts in the comments below. I read all of them, and I'm always curious to see how other investors are thinking. If you got some value out of this breakdown, hit that subscribe button so you don't miss the next video. Thanks for watching, and I'll see you in the next one.